All right, my name is Richard C. Wilson. I'm the founder of the Family Office Club. We got started in 2007. We've now grown into a 16-person team. And today's webinar is going to be on Q&A for ultra-wealthy investing and investments. We're going to talk about family offices, questions you have about structuring deals. We're going to talk about what investors are looking for, how they're dealing with the crisis, maybe challenges you're having on investor relations or setting up your family office. Pretty much anything you would like to talk about. On these types of webinars, we always have people saying, do you know anyone who wants to invest in my battery company based in Idaho doing $500,000 in revenue, or, my real estate deal on 8th Street downtown and in Seattle, et cetera, very specific deal kind of pitch questions. I'll try to answer those in a way that's categorical for people of related areas so that other people on the webinar benefit from answering those as I can. But as you can, it's best to ask questions that others can benefit from hearing the answers to, obviously, to some degree. So I had a couple questions come in actually before the webinar, and I wanted to address a couple of those I've written down here in my notes. One was from Jim in the senior living space. He was asking about investors preferring joint venture deals versus preferring something that's more of a blind pool fund. And this is a pretty clear answer. In my mind, if you're established enough, you should offer direct investments and a fund, because my experience is that 60 to 80% of ultra wealthy single family offices prefer to go direct into deals, but some prefer a fund when it comes to senior living or real estate. Most family offices do invest in some funds, but they get some of those from their private banker or a banking wealth management platform. So within the investments where they're going to go direct to something and source something themselves, they typically feel more comfortable going direct. For institutional investors, the 80-20 is flipped the other way. Most of them want to invest in a fund, and it might be highly appealing that after conducting due diligence on your fund, you might give them co-investment rights that gets them access to deals at a lower fee schedule and adds a bit more transparency so they can double down in areas where they want more exposure quickly. But I would have both if you could. If you're not sure, I would offer the direct investment model and not offer the fund model until you've grown large enough to offer both. Is basically what I've been seeing out there. Another question here about what we've been doing at the Family Office Club during the lockdown quarantine time. We've done many things to become a virtual digital investor club. So we have recorded dozens and dozens of investor mandates just this week. We're recording 25 different investor mandates just this week. So every day we're recording multiple mandates. And what that means is a 5 to 7 minute video saying exactly what the investor wants to invest in, what the scope of their deal flow is, what regions they like, where they're based. And then, they give one piece of advice as well on that short 5 to 7 minute interview. The more that we can be recording those investor mandates, the better. Every week we do a webinar. Every week we do a discussion panel with 5 to 6 investors. Price of oil went negative yesterday and the day before. And we're doing a oil and gas energy panel tomorrow with 5 different investors on there to share their perspectives. So those are interesting. It can be educational, as well as maybe finding an investor lead through there or an insight that'll help you with all the investor leads you're sourcing. But in terms of other things we're doing during the quarantine, besides releasing one investor mandate interview every day, we're really changing the interface when you log into the portal to be able to submit your materials more easily for review, find the relevant mandates more quickly, and also take advantage of our workshops that equip you with 150 capital raising strategies. Personally, I'd always wanted to run a marathon. So a couple of weeks ago, I did that on a Saturday. I was actually in quarantine lockdown in my office, literally day and night, because I'd been exposed and my family had not. So I had the free time on my hands and just trying to now enjoy time with family, put out a lot more thought leadership. Yesterday, I had 11 recorded sessions on the calendar with different investors and webinars that others were putting on where I could speak on, et cetera. So those are some of the things that I've been doing personally and just as a business, during this time. So we've got 17 questions in here, so we're going to try to move quick through them. What are the high net worth individuals looking at specifically as it pertains to alternative investments? Still largely private equity, direct investments, or are they considering public equities? All of the above. First of all, we have 2,000 plus registered investors. We're up to 113 now that I represent directly under contract, meaning when they invest through me, I'm getting a little performance fee on the investments they do through me. And we take our fees from the investor, not the person raising capital, importantly. But we have 2,000 total in the investor club as members. And so if you're looking at all of the above, I would say right now to be more helpful to those here listening is that on average, the investors I'm speaking to have put 10 to 25% of their capital back into public equities. I'm not saying everyone should run out and go do that now if you haven't yet, but in the month of, in late March, mid to late March, a lot of them had started putting on those positions, or now here in April, put that on 10 to 25%. I don't know anyone who's gone fully all in back in the market because a lot of people think there might be a deeper bottom than we're at right now. On real estate, a lot of stuff hasn't repriced. I don't know if the member is on here today, so I don't want to name them, but I got approached just yesterday by a member through Jennifer, who's kind of our member happiness coordinator, and Jennifer sent over some information from this member, and it was on a retail investment opportunity, priced at, I don't know if it was 70 million or so. And it looked like it was priced, pre-crisis. And I said, well, none of those retail shops are open right now, right? And, when they do open up, demand could be lower. People might be buying stuff online, or maybe the restaurants can't have as many people in them. Have they repriced this for the crisis? And she said, oh, no, they haven't. I'm just kind of been sent out to get feedback and stuff. I'm like, well, the feedback is you're not being realistic because it's not, in line with what's happened in the real world. Via LinkedIn, I was sent 3 hotels in a major U.S. city that they said had a $22 million NOI, and they wanted to sell them at a 7% cap rate. I said, well, they're not earning $22 million NOI right now, so I really don't think you're going to get that deal done at a 7% cap rate unless there's some downside protection there, or it's a real excellent location property, et cetera. It's just going to be tough if you haven't adjusted the prices for real estate because there's an unknown factor. People don't know how much to adjust them down. So if it's not really good enough to make them lean forward, why would they move right now? I might as well collect, get more information, and then move forward in a little bit versus right now, unless there's a discount applied to that big question mark. A lot of people do not think there's going to be a V-shaped recovery. The stock market might show one and might reward you perhaps if you invest, whether things go down to a new bottom or not, perhaps because of stimulus and everything else, the stock market may jump back up a percentage, but that's not the area we really focus on. And we're just seeing a big disparity between what the stock market is doing and small businesses struggling, record unemployment, and there's no way all those people are getting hired back when we're quote unquote open for business, which will go through phases. Because a lot of those companies are just going to slowly hire based on how many people are coming into the restaurant or their movie theater, et cetera. So there's going to be a massive amount of unemployment here. And I think we're in for, the worst maybe, yet to come economically with the results of all this stuff. What's the bias against aviation and airline space given the current environment? I don't think there's a massive bias against aviation. I think aviation will pick up before rental car and hotel because someone might want to see a family member, do a quick business trip, come back the same day, or they might do a trip somewhere and stay with family members and might not, the rental cars, they could be using Uber instead of rental car, et cetera. But I don't see any big bias against the airlines. I mean, I've seen that Buffett has 2 or 3 positions in airlines, and, he has always said, be greedy when others are fearful and be fearful when others are greedy. Who knows if half of them are going to go bankrupt. So it's a pretty risky investment to be looking at. But I know a few family offices who actually like the fact that everyone's hating them right now because of the potential value upside there. This is a question from Pete, a renewable energy company. They're finding company capital has been challenging. What's the best way to pitch renewables or impact investments? The thing I would always think of is who already knows you well, who knows that industry well, and who's local to you. Those are the people who are already up trust curves, or you can move them up the trust curves as fast as possible. I would also look for, if you're doing renewable energy infrastructure, it sounds like, look for publicly traded companies, look for corporations that would strategically benefit by partnering with you and helping lower your cost. Many people go out and say, oh, we need to raise $20 million. But if they had a big brother partner that gave them some infrastructure access, maybe they only need to raise $6 million or $8 million, or maybe that big brother partner will provide half the funding plus infrastructure if they can go find the other half of the funding. So I would think through those types of ideas. Is it realistic to raise 100% equity on commercial development? What should I ask as a sponsor? It's supposed to be commercial real estate development, I'm guessing. Most people put up 5, 10%, sometimes a little bit more for commercial real estate development. But you could raise 100% equity. You might give up more on the economics. If this is your first raise, you might have to give up a lot of things to make it work. You might want to co-GP with someone who can help you get the raise done to de-risk you never getting it to the finish line. That's a massive risk if you're in your first deal or 2 or 3. So I'd consider those options. You could go to a sponsor who's knocking out deals like yours all day long, perhaps, and say, hey, I found a great deal. I think I can raise part of the capital. If I don't raise any capital, can I be an X% partner? If I raise this much, can I be this percent? And figure out if there's a way to de-risk the deal not getting done. There's a question from Dan. Hey, Dan, thanks for joining us here today. With everybody in the world going online, what is the appetite to invest in media tech, content tech companies? Thanks. I think that there is an appetite, but the biggest appetite is for those types of companies that have a subscription model, reoccurring revenue model, a model that's doing even better now than before the crisis. I just have a thesis that they're going to start naming these viruses like they do hurricanes each season and say, oh, we got, virus XYZ coming out of the Philippines. We've got this other virus coming out of Brazil, and you're going to see a tracking map like you see on a hurricane, and they're going to name these things. And people, it's not going to be the last time we go on lockdown. Politicians will want to be the hero by, locking down their whole state early and waving that flag to help them get reelected and protecting people from getting sick, I think. So companies that not only are surviving but growing during this time, which Inc. magazine says is only 1.5% of all companies, are things I think are going to get the most attention from investors. But I don't think they have anything against media tech or content tech. But an existing company is always easier than a new one. Could you discuss the individual family office models that exist? How are they different at 100 million, 500 million, a billion? Thanks for that question, Matthew. So many people form a virtual family office for a very lean solution when you want to keep your overhead low, outsource almost everything. And let's say you buy dry cleaners. Well, maybe you want to have your own little team for scouting, negotiating, structuring, dry cleaner acquisitions, and your personal financial affairs, maybe a half-time person or 1 or 2 full-time people. And you could have them work remotely or just have a very small office. That would be a virtual family office for one person. A single family office typically becomes more practical in a full-fledged sense, meaning you've got 2, 3, 4, 5 or more full-time professionals, and you're doing a few more things in-house. That might make more sense when you get to 50 to 70 million or 150 million or 100 million plus. We have some clients that are at the 50 to 75 million that have 3-person family offices. We have several clients over the 100 million mark that have 10, 12-person single family offices. A multi-family office is when someone's set up to serve 5 families, 20 families, 100 families, and you usually have to have a net worth of 5 to 7 million to join one of those these days. The requirement used to be 10 million plus, but a lot of them will take you in at 5 to 7 million. If anyone needs connections on those and figuring out the right solution, just fill out the form at our investor portal. It's at privateequity.com. It's only for investors. It's not for anyone raising capital. If you're raising capital and you want to work with our investor club and you want us to see your deals and get to know you and learn our 150 capital raising strategies, go to familyoffices.com. And if you scroll down, there's a registration form on the homepage. And if you register at familyoffices.com, you can join the investor club as someone who's looking for investors or clients or raising capital. Strictly an investor, you go to privateequity.com. So if that answers your question, Matthew, we have a ton of education on that. We have over 300 videos on YouTube, and we've published more on YouTube in the last 6 weeks than we did, I think, all last year to give you a taste of what you can get in the membership. Important to note is that any investor mandates you see on YouTube have bleeped out their last name and their contact details and their firm name. You only get that if you're a member. If you see discussion panels on YouTube, you're only getting the first 10, 12 minutes. Then we cut it off. The rest we give to members within the membership portal. So those are some of the benefits of joining the membership. what kind of recovery are high net worth investors projecting once lockdowns are lifted? I've seen three now: V-shaped, W-shaped, and possibly U-shaped, with a fall 2020 recovering. I think that it's definitely not going to be a V-shape, and I don't know any investors who think, oh yeah, where's this higher back, all 22 million people immediately, even though no one over 60 years old can really go out in public without a vaccine, and even if you get antibody tested, which I am today at 4:30 p.m., even if you get that, 130 people in South Korea supposedly got reinfected after being sick. I don't know if that's Russia, China, planted news that was not real, is one way to describe it. Or if they're going to find that you can get reinfected. But a lot of people that are at risk are not going to rush right back out to restaurants and theaters and not want to even go back into an office environment. So I am very confident that we're not going to have a V-shaped recovery, as sad as that is. Would love if that happened. I don't know the logic between W-shaped versus connecting three W's to each other and we just have volatility, but I think it's going to be rough until there's a vaccine out, or until we get very clear, guidance on whether the antibodies actually mean anything and you can get reinfected or not. I think is one stage of improvement, but I think it's going to be a rough time, to be honest. But we're taking more actions now with content, with investor work, with onboarding new investors than we have during any other period within our company. And now there's more opportunities being created now. I mentioned on our last webinar, so I won't go into too much detail, but there's a company that shut down 2 years ago, and I wanted to acquire their assets and their company formulas, et cetera. And they didn't respond. Well, now I'm reaching out again because maybe they like cash more now than they did and would appreciate the money. We're also reaching out to a company that their product was just bumping along, had amazing reviews online. I've known them for 6 years. And we contacted them, they replied, and they said, hey, we have other good uses for the money, and this is kind of a side orphan product for us. And it's doing $500,000 a year in revenue. We'd probably sell it to you. I mean, what would you guys want to buy it at? So we're doing due diligence on that for a holding of a company that I invested in twice now. So it doesn't have to be distressed. You could be investing in something that's doing better than ever. You're helping them go faster. You could be buying assets from someone who, I know my brother was working on a deal where someone had closed the doors and someone else said, no, don't close your doors. We want to buy your company. And the person got money and they weren't going to get anything. In other cases, you could be a lifeline. It could be the difference of employees getting laid off, or a company going to zero, or somebody's life work getting destroyed. And maybe they had 100% and now they're only going to be 50-50 owners, but they were going to be 0% owners. So I think all those things need to be kept in mind, because people have a real vulture type mentality, especially in the media, about what investors do during a time like this. But they do what's logical, which is try to make the market more efficient and, address the risks that they're taking. What are you doing to capitalize on spiking gold prices to deal with the market turmoil? Personally, we're not doing anything in gold. I'm not really an expert on precious metals. I've never spent a ton of time on that. I actually have some shares in a gold bullion vault company that stores gold for ultra wealthy families, because we helped them out 3 or 4 years ago and getting some exposure in the family office club. And they have a pretty large operation, but I'm not working in that area day to day, and we don't advise clients on that. I do know that there's some precious metals that some investors take positions in before a situation like this, because some of them spike up every time that the market goes down, it seems, or it's likely to go up. But it's too late to be trying to do that at this point. Have you noticed a slowdown in deal flow and processing by family offices? No slowdown in deal flow. I think deal flow is up. I think it's up 25 to 33%. We're looking at a couple of deals right now where the person doesn't need the capital. They're doing well, but they think there's going to be a distressed opportunity or two. So they're shoring up their capital base. We're looking at one right now that was doing great before the virus hit. Now they're shut down. They're okay as long as things half open up in the next month or two and they can start seeing patients again. Then they'll be okay. But they would feel better having more capital secured now, because they want to keep expanding, and they'd rather be ahead of that game than scrambling when they need the capital to open their next few locations. That same group has also identified a peer that's struggling, and they might be able to acquire them on a distress basis. I would say not only is deal flow coming at us faster, we're requesting more of it. So we sent out an email asking for deal flow teasers, and we got about 250 responses. I've gone through those, and there's about 17 that look like a potential match for some of our clients. The others we can still keep in mind, of course, if there's a match. And just looking through those, trying to create opportunities for our investors to help them in taking actions. And I feel like March was really a twilight zone period for investors, really not knowing what's going on, a lot of fear and just protecting their portfolio, a lot of people going to cash. We never talk about the stock market, but luckily on the 28th of February, I said on our podcast, hey, I'm going to cash. Who else is going to cash? And one person emailed me saying, oh yeah, we're going to cash. And no one else bothered to email me or didn't agree with it. But now in March, there's a lot of fear. And now in April, I feel like people are adjusting and getting their game plan in place. So maybe they'll put a little bit back in the market, but they're not planning to put much more in until they see if there's a new bottom. And that means they're sitting on more cash than they usually are. Also, every sophisticated investor I know was sitting on cash going into this. They all knew we were 11, 12 years into a cycle. So why would you be 100% allocated? Almost everyone was sitting on cash already. That's the good news about this. And so I think investors are trying to figure out, what are their strengths? What are the things which they're excellent at? Where have they made a lot of their money? What do they trust in? What's doing well in this environment? Where can they invest in something distressed that's in an area where they understand or could add strategic value to? And because of all that, I think deal flow is up. And I think investors are getting their ducks in a row to take some actions. And like me, they're hoping to take 2 to 4 actions on investing in deals and getting big things done during this time. So I think that's really important to note. We're a small RIA that is trying to change our methodology to be a catalyst for new business. Any thoughts? Zandy, if you can just follow up and just clarify a little bit more about changing your methodology to be a catalyst for new business. I'd be happy to comment on that, but I would mention that we have 5 different 5.5 hour long workshops where I talk just as fast as I am now, and I cover 35 strategies at each of those 5 workshops that would all help you grow your RIA. A lot of people come to the Family Office Club to grow their investment firm that's raising capital in a traditional sense for a private equity project or an operating business. But if you have an RIA or wealth advisory business, you can use all those strategies to attract clients directly to you. And you can see what we're doing in real time to attract investors to the Family Office Club, attract investors to our privateequity.com investor portal. You can see that we don't just say advice to fill up time on a webinar, that we believe in it because we tell people to niche focus. And we have a sleeve of our investor division focused on dentists and doctors called Doctors Family Office. You can see that at doctorsfamilyoffice.com. We're just rolling that out in beta right now. So plenty of ideas for you, Zandy, within the membership. If you want to register, on our website, there's a ton of help we could provide you there. Perceived appetite to invest in a sports franchise. Well, right now, very little, because you can't go to see sports. So, what's going to be the runway for launching such a thing? If you have syndication rights in place and there's subscribers and there's a way to make it work and bootstrap it, then perhaps there could be an interest. But until people can go to sporting events, unless you have a very strong online viewership model, I think it would be very challenging. But in terms of people getting their plans together in April for investing in May and June through the crisis, or in this example with the sports franchise, it doesn't mean you just don't try. Like, oh, okay, well, sorry, honey, I'm just going to stay at home and, watch Netflix and enjoy some Tiger King if you can possibly enjoy such a thing. Because I can't, Richard said, I can't, get much done in my capital raise. That's not the point at all. The point is, I wouldn't expect a whole bunch of wire transfers to come in 6 weeks after you start, talking to investors about that. But investors want to get to know you. They want to see what genuine value add you have. They want to see what insights you have. They need to be educated about you, your team, the marketplace, the opportunities. You can still be planting all of those seeds so that when things come back, you hit the ground running. If you wait until things come back, then you're going to be 3 to 9 months behind the ball, and you're going to be off track for getting anything meaningful done in that first quarter after things come back. So Matthew, again, from what I understand, the more wealthy the family offices are structured like companies, like buddies from high school involved. Family office usually, as they get professionalized, set up an LLC to mitigate risk. They might have payroll. They might even have a brand and do marketing for their family office to get more deal flow. We talk about that at our Private Investor Advantage workshop, which is one of our 5 full-day workshops that we've recorded in the portal for you. Some do co-invest let's say they're a manufacturing family and they've got 3 or 5 peers, or I know one in the auto industry, they all meet in one city once a year, and there's 12 of them. They're all 65 years plus. They're all worth 50 million plus in the industry, and they trade investment ideas and invest with each other and trade deal flow. So many times they have their own structures, and to be able to write certain things off, it can help to have legal structures around the virtual family office or single family office. And there's different variations for virtual family office and single family office. One I didn't mention is a multifamily office model where they're basically helping you structure your single family office. So they're serving many different families, but basically helping them all set up the infrastructure for their single family offices. Also important to note is that investors who register at privateequity.com, we give them free advice, free resources, introductions to a family office accounting firm if they need that, or what top wealth advisors we know, et cetera. So we're happy to help, and we don't charge a consulting fee for that. We used to, and we found out that after 18 months, we kind of run out of smart things to say about starting your family office, and people don't want to pay the retainer anymore, and I don't blame them. So it would always shift to helping them source direct investments after they were formalized. Now we flipped it. We said, don't pay us anything. We don't need a consulting fee. We don't need a management fee. Just pay us a profit share on the gains off of investments that you do through us, and we'll just show you conservative family office quality type investments, unless you ask for something very specific otherwise, and just give away for free the consultant advice that others are charging $300 an hour for. And that's what we do to get our foot in the door, which is one of the things we always suggest, through the club to our members. I'm seeking $5 million checks from multiple families for an opportunity zone opportunity. I don't have relationships with family offices. Any advice on how to find the right family offices to raise capital? I'm biased, but number one piece of advice, for $300 a month or $1,500 a year, you can get 100 times more advice than I could possibly say in a 2-minute answer here by becoming a member of the Family Office Club. And I genuinely think it would massively help you if you're not a member yet. Other piece of advice is I am on the board of a real estate development firm. They're at $250 million in assets, and they have 3 investors. They didn't know what a family office was when they came and got involved with the Family Office Club. They learned about it. They went straight to the top, going for large investors. The founder calls potential investors every week. They participate in a few relevant events per year, usually just 4 to 6 events per year. And they do outreach locally within their community, and they set up custom terms for investors to appreciate, their requests. But that's one example of someone who's gotten it done in a big way with big investors. My other advice is to listen to our webinar that we did on the 7 ways to leverage our investor club to raise capital. I think all 7 of those ways would be relevant to your question here. And honestly, our whole collection of thought leadership and what's inside the member portal is to help people with investor relations, raising capital, getting better quality deal flow. So it's hard to answer in a sentence or 2, but some of the things that help people is doing what others are not doing, using direct mail, using text message, using video to introduce yourself, introduce your ideas, be concise when everyone else is being long-winded, respect their time, follow up consistently, focus enough, have a CRM, be systematic, make sure you're positioned well against the competition, what your investors are looking for, plus your own strengths and weaknesses. So you stand for something really unique and dominate a sandbox, use choke points. There's 100 different ideas to help you with that we don't have time to cover right here. What's the percentage of preference for family offices for direct deals for non-real estate seed investments? There's no one percentage, Julie. I like to structure gross revenue royalty deals. We've done 5 of them. We're negotiating the 6th one now, where we invest, we get a gross revenue royalty off the top line revenue. Once we get all the money back, plus X%, then our equity stake or equity warrant goes down. Other people like to do venture debt and get a 10% note and get a few percentage equity points in a company. Other people like to do convertible notes. Others like to do just straight equity investment. And some investors who are worth 50 million or more might prefer control if it's in the industry where they made their money, or if they're just a family that likes control. Other families that are worth less than 15 million are much more likely to want to be passive investors. Again, if it's the area that they know real well, they might want control, or at least veto control at some level. But I hope that helps a little bit with guidance. I do think, based on that question, Julie, that investors do like income, and knowing they're getting at least their money back off the table is highly appreciated and usually not offered to them. People usually offer, hey, do you want to invest in my company that's a year or two old? And you could have 20% equity, but then they could get diluted. They could see no profits for 5 years to come. Investors just got their 100% of their principal off the table, and then maybe had their position reduced a bit after that point. I think it's appreciated by many investors out there. What are you seeing in terms of ultra wealthy family offices, in terms of real estate deals, developer and micro apartments, urban core is naturally affordable? I think the people that have more affordable options right now are going to be helped by the fact that some people were saving up to buy their first house or their next house or to refinance their house. And people are going to be more conservative for a while now. Everything was going so well for so long in the economy. Now, a lot of people have kind of been gut punched, they've been laid off. The value in their companies have been eroded. And because of that, they might say, you know what, let's not take our life savings to buy that house or our emergency cash to buy that house. Let's sit on our emergency cash, because who knows if we're going to get laid off, or who knows if our business is going to get wiped out on a deeper level, or our clients, suddenly stop paying because they lost their jobs, et cetera. So I think that the urban core, more affordable type deals could be good, because people will always want to be close to work. At the same time, I see articles about people talking about rural location properties and people wanting to get out of the city. There'll always be a percentage that are going to want to be in the city, in most cities. And then there's going to be a percentage that react to this and say, well, I don't want to be cooped up in this little apartment if this happens again. Let's go buy a house in the country. We're working virtually anyways, so why pay these expensive prices? So I see both sides. Obviously, if you're doing a downtown apartment that was premium priced, it'd be a lot harder than something that's naturally affordable. In terms of what I'm seeing in terms of real estate deals, I'm saying that those that don't adjust their valuation or their risk profile for investors are not getting much deal flow, not getting many deals completed, and not getting a lot of responses, because investors say, well, until this thing figures itself out, why would I allocate now? I can allocate at quote unquote market or 2019 type market prices anywhere I want to. That's essentially a premium because the market has gone down. And I saw so many social media posts of people saying like, oh yeah, look at real estate. We didn't dive 30% today when the stock market went down. And it's like, well, all those families that felt that, maybe they think, well, the real estate is down a certain percentage. Who knows if it should be down 5% or 20% or 10%. But a lot of those investors think it just hasn't corrected itself to be reflected in the real estate. And so everyone's hoping for a relatively quick recovery here. So maybe the real markdown is not big, but there's an unknown question mark there. So I think that it has to be reflected. And some people are offering a rebate to investors who invest, and they give them 3 to 5% of their money back. Some are giving them more of an income structure, a royalty structure, et cetera. What percentage of family offices have been looking into co-investments? Among those, how are they sourcing these co-investments? They source them from each other a lot of the times when they do co-investing, from their peers. They get involved into investor clubs. It's part of the value, Richard, of being in the family office club. We haven't paid a single investor to do the 45 investor mandate interviews we've done in the last 20 days. And I recorded, I think close to a dozen of those this week already. I'm not paying them to do those interviews. They want to get deal flow. And so they look to their peers, investor clubs, different associations they're part of. They don't think of a co-investment typically as coming from a private equity or VC fund. They see that as a direct investment or a fund investment. I don't think they would call that a co-investment, but a lot of them do invest through independent sponsors. So they have transparency deal by deal versus a blind pool fund. What level of interest is there in a startup that has a patent and process from proven technology executives? Could be a game changer. So James, this is a good question, because there's probably other startups here that have technology or IP, and raising capital for any startup in any time is usually very challenging. Some people, are in the right time, right place, and it takes off. But almost everyone has a challenge with raising capital for such a thing. One of the keys is to have an excellent team.com board. If you want to schedule a phone call, you can email there as well and schedule a phone call, or you can call in to our company at 305-503-9077. If you've enjoyed this webinar, as I've mentioned 3 or 4 times, you're probably going to enjoy our full day workshops and the other content within the club. So I'm hoping to see many of you in there. and just keep on logging in maybe twice a week to see the new panels being posted, the new investor mandates being posted. And it's a great time to be looking at the workshops that we provide, because in one workshop, we'll give you more ideas than you could implement in a month. But by watching 5 of them, you'll be able to say, okay, out of those 35 strategies in this one, here's the 3 I can move on now. And this other one, here's the 7 things I could move on. You can create your kind of plan for moving forward with a really robust, much improved investor relations and capital raising process that otherwise would not be possible. And I think over 18 months, we can transform everything you do as it relates to investor relations and capital raising. And a lot of our ideas are not, oh, now I understand it and I can just go do it. You actually have to put in the infrastructure, put in the work, put in the positioning, do the exercises, talk to your team, talk to your partner, get feedback, put in the next iteration of it. And if you don't start doing that homework now, you're just going to be 18 months behind the other people who are putting these industry leading best practices into place in real time right now. So hope everybody enjoyed the webinar here today. We're going to do these Q&A webinars probably once a month, and then our other webinars will be a bit more topical, focused on a single idea or a single type of investment opportunity or a single strategy that we feel like the community is asking for a lot of the time. So take care and hope to see you within the club. Bye.